Hi there, I'm Jason Ayers, founder and president of OptionSource.net, and thank you for joining us to learn about selling put options. Many investors sell put options to generate income, profit from range-bound or bullish stocks, as an entry strategy for a stock position, or to average down on a losing position. Selling puts while having sufficient cash in an account to cover the obligated share purchase is referred to as being cash secured. In other words, the cash-secured put seller is not using margin to create a leveraged position. The risk in this strategy is associated with owning the shares at a price below the sold strike. In-the-money put option premiums are made up of both intrinsic and time value. The intrinsic value of the option offers the put writer increased upside potential. It is important to have a bullish outlook on the underlying when selling in-the-money puts. An option is considered to be at the money when the stock price is equal to the strike price. These options are made up entirely of time premium and offer the investor the greatest return if the stock does nothing within the expiration time frame. This is also referred to as static return. Writing out of the money put options allows for a move down in the underlying security before the put seller is obligated to buy the shares. The out-of-the-money put writer collects a small premium. However, the probability of being assigned to purchase the shares at the sold strike price is much less than that of the at-the-money or in-the-money right. With XYZ trading at $50, a 2-month put option at the $50 strike may be trading at $2.50 per contract. The investor sells one put option for every 100 shares willing to be owned and collects $2.50 per share in premium. When selecting a strike price, the in-the-money put writer has a higher probability of being assigned to purchase the shares. In this example, if the share value remains at $50, the return is limited to the time premium collected. The at-the-money right would produce the greatest rate of return if the stock remained at the same value over the 2-month time frame. The out-of-the-money option right results in less return. However, there is a higher probability of the puts expiring worthless and the put writer collecting the entire premium without having to purchase the obligated shares. By selecting the at-the-money option, the investor in the preceding example sells 10 $50 strike put options and collects $2,500 in cash flow. If the put option writer is assigned, the adjusted cost base of the investment becomes $47.50. This is determined by subtracting the premium collected from the $50 purchase price of the shares. With the option premium being made up entirely of time value, the at-the-money option sale generated a 5.26% return over the 2 months. The collection of the $2.50 premium established a break-even point at $47.50. The put writer will not incur a loss until the shares trade below this value. If an investor wishes to purchase shares at a lower market price and is waiting for a pullback, a put may be sold at a strike price close to the desired entry. The cost base of the potential investment is reduced while the investor waits for the shares to pull back. A disadvantage is that the upside potential of the stock is lost if the put seller is not assigned while having assumed the downside risk below the strike price sold. An investor that has experienced a depreciation in share value may wish to purchase more shares at a lower market price, therefore averaging down on the position. Puts may be sold at the desired average down price, resulting in immediate cash flow. If the shares are not trading below the sold strike at expiration, the put expires worthless and the put writer keeps the premium, offsetting a portion of the loss in the stock. If assigned, the put writer still keeps the premium, but also takes possession of the shares at the strike price and as a result has averaged down on the original position. As a reminder, the short sale of a put option contract requires the seller to put up a certain amount of cash as collateral. A put seller is referred to as being naked when margin is used to meet the specified requirements. This creates an undefined risk as the put writer may be forced to purchase the obligated shares at the strike price regardless of how low the shares are trading in the market. The risk of loss below the strike price is similar to owning the stock. If XYZ is trading at $50 per share, a 2-month put option at the 48 strike price may be trading at $2 per contract. The investor may sell 10 put options collecting $2,000 in premium up front. In this scenario, the put writer does not have sufficient cash to cover the obligated share purchase and is using margin. This is considered being naked. As with the cash-secured writer, the naked put writer has created an obligation to buy 1,000 shares of XYZ at $48 within the specified time frame, regardless of how low the shares trade below the strike price. If the share value remains above the sold strike price of $48 until expiration, the options will expire worthless and the naked put writer will keep the entire premium. Note that the maximum profit for the put writer is the premium collected. As the share value of the underlying drops, the put premium begins to appreciate and the put writer begins to incur a loss. The break-even point is determined by subtracting the put premium from the sold strike price. In this case, subtract a $2 premium from the $48 strike and the break-even at expiration is determined to be $46 per share. The put seller will assume a loss equivalent to the difference between the strike price and the lower stock price minus the premium collected. It is important to note that the put writer may buy back the short puts before expiration to eliminate the obligation. However, the loss will still be realized as the put premium will have increased to reflect the change in the underlying shares. Options can be combined with one another or with the underlying security to result in what are known as synthetic positions. For example, selling put options has the identical risk-reward distribution as covered call writing. As a reminder, the investor who sells a covered call collects a premium by taking on the obligation to sell the underlying security at a specific price. The covered call writer assumes the risk of owning the underlying security. The risk in this position is offset by the premium collected, but is undefined as the share value drops. The put writer does not own the shares, but collects a premium for taking on the obligation to purchase them. As the share value drops below the sold strike, the put writer incurs a loss comparable to owning the underlying. The loss is offset by the premium collected, but undefined as the share value drops. This risk graph reflects the limited profit potential of both the short put and the covered call position. Note that in both strategies, the risk is undefined as the share value decreases below the break-even point. It should be noted that if the put writer is assigned, a long position in the underlying security is created and the investor may profit from any increase in the share value. This holds true for the covered call writer if the written call expires without the investor having to deliver the shares.